Hello everyone and welcome back to another video. So about a month ago, I made a video on what the intelligent investor had to say about stock market volatility and stock market crashes. In that video, I asked you all if you wanted me to do a chapter by chapter review of the intelligent investor, and your guys' response was an overwhelming yes. Since so many of you wanted me to do a chapter by chapter review, that is exactly what we are going to do. So this is going to be the first iteration of this entire series, and this is probably going to be the biggest series that I have ever done on my channel. There is so much golden content in The Intelligent Investor, and yeah, I just think that anyone who is not reading this book and trying to really understand what it has to say is seriously missing out on some absolute golden wisdom and golden lessons. So what I'm basically going to do is I'm going to go, as I said, chapter by chapter through this book, and I'm just going to show you guys all of the key things that I find in every single chapter and all of the best, I don't know, golden nuggets, let's call them, in just every single chapter. Now, with that being said, this book has gold on pretty much every single page, and I just can't cover every single page. That would just take way too long. No one would watch that. No one wants to watch that. So yeah, I'm not going to cover every single page, so I am going to be leaving out some things. So the absolute best thing to do if I were you would just be to buy the book. Go and buy the book and read it for yourself. I also think that it could be cool if you haven't read the book, so go buy the book and then follow along with this chapter by chapter analysis. I'm going to try and do a chapter every single week until we finish the book, okay? That's probably going to take like half a year, but we're going to do it. We're going to finish The Intelligent Investor and we're going to have a great time doing it. So in this video, what I want to do is cover the introduction to the book. There is some really good golden nuggets before the book even starts. And yeah, that's what I want to cover in this video. And then in my next video, we'll start with chapter 1 and we'll actually get started going through the book. With that being said, I think I covered everything that I need to say. So let's just hop into the computer and I will start recording on my computer and we'll just go through all of the passages that way. So I'll see you all in the computer and I really hope you all enjoy this series. All right, so let's just dive right into The Intelligent Investor. And let's start on the page IX. This is the preface to the book, and this section right here is actually written by Warren Buffett himself. So this page says, "To invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions, and the ability to keep emotions from corroding that framework. This book precisely and clearly prescribes the proper framework. You must apply the emotional discipline." So this first highlighted passage right here from Warren Buffett is basically saying that to invest successfully, you don't need a ridiculously high IQ, and you really don't need to be a genius. What you need is a framework for making decisions and the ability to keep your emotions from corrupting that framework. So basically what this means is that when we are investing, the more that we can detach our emotions from our investing, the better off we will ultimately be. There's actually a saying that logic has a hard time triumphing emotion, and that is very true when it comes to investing. A lot of the time we find that investors make very emotional, quick decisions that aren't really based on logic because they're either too focused on paying attention to what the price is doing and not what the underlying business is doing. Now, the other thing that Warren Buffett is saying here in this first passage is that the intelligent investor provides investor with that framework of thinking. And then our job as the investor reading this book is to supply the emotional discipline. And that is not going to come from anyone else but ourselves. And sometimes, honestly, this is the hardest part of investing, is just controlling our own emotions and controlling ourselves and not letting emotions corrupt our investing framework. So that is our job as the investor reading this book. And throughout this book, we are going to receive that framework of thinking towards investments. So let's continue on then. The second highlighted passage here says, "Whether you achieve outstanding results will depend on the effort and intellect you apply to your investments, as well as the amplitudes of stock market folly that prevail during your investing career. The sillier the market's behavior, the greater the opportunity for the business-like investor. Follow Graham and you will profit from folly rather than participate in it." Now, for those of you who may not know what stock market folly is, and really just what folly is is like foolishness or stupidity. So what Warren Buffett is trying to say here is that the more stock market foolishness happens, or the more foolish that investors are during our investing career, the more successful intelligent investors will actually be. And through reading The Intelligent Investor by Benjamin Graham, we will learn how to profit from stock market foolishness rather than participate in it. And stock market foolishness can be, it can go both ways. The stock market can be foolish when stocks are going up and the stock market is pricing companies too high. And the stock market can also be foolish on the way down. It can be over pessimistic to some stocks and just sell them off to the point where they become ridiculously cheap. So on both ends of that, an intelligent investor can profit. We can buy from pessimists when the market is being foolish and being too pessimistic and making stocks too cheap. And then we can sell stocks when the market is also being foolish and pricing stocks too high in over-optimistic periods. And Warren is also basically saying that the intelligent investor, this book right here, will help investors understand when stock market folly or stock market foolishness is taking place. We will be able to recognize it and we will be able to capitalize on it rather than participate in that foolishness. So yeah, that is what Warren Buffett is trying to say here in the preface, I believe. Now, the next page we're going to talk about is no longer written by Warren Buffett. And this page is XIII, and there are 5 key points here on this page that investors need to know. So let's just go through these points one by one. And the first point says, a stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business with an underlying value that does not depend on its share price. So what this first point is trying to say here and drill home to investors is that when we are investing, we are not just buying these electronic numbers on a screen. When we are buying shares of a business, we are actually investing and buying ownership of that business. So a good example of this would be like Microsoft. Everyone knows what Microsoft is. So when we buy a share of Microsoft, we're actually buying a very, very small piece of that business. And we are becoming a part owner in Microsoft. Now, how most investors value the underlying business is by taking a look at how much cash that business can return to its shareholders. So when these, when these prices are fluctuating around on the screen, that really can be irrelevant. What is the most important thing to value investors and investors who pay attention to the actual value of the company is how much cash can that business return to you versus the price you are paying for it. Investing really doesn't depend on what the share price is doing from day to day. And as we'll find out later in the book, that is actually speculating when you're trying to just guess like what the stock is going to do next week. Investors focus on the business, they don't focus on the stock price. So now let's move on to the second point. This says, the market is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap. The intelligent investor is a realist who sells to optimists and buys from pessimists. So just like how Warren Buffett was saying that there is stock market folly or stock market foolishness that takes place, this is right here is basically backing that up and saying that the stock market is this pendulum that constantly swings from investors being way too optimistic and overpricing stocks to then becoming way too pessimistic and underpricing stocks. And it's just this pendulum that constantly swings back and forth, and the intelligent investor does not get caught up in this pendulum swinging and all of this foolishness. What they do is they buy from the pessimists when the stocks are becoming too cheap, and then when stocks get overvalued and everyone is super optimistic, that is when the intelligent investor stays realistic and sells to those optimists. So that is what this second point right here is trying to say. And that also backs up Warren Buffett's section in the preface where he says, the more pendulum swinging or the more stock market foolishness that takes place during your investing career, the more opportunity there will actually be for intelligent investors. So now let's move on to the third point right here. And this says, the future value of every investment is a function of its present price. The higher the price you pay, the lower your return will be. This is actually 100% true and accurate. And I'm actually just going to pull out Photoshop and show you guys a super artistic drawing to make this point clear. So right here on our chart, this is where the stock ends up. And let's say that this was our estimated value of the stock when we were starting to invest in it. And now let's say that we bought the stock right here. And let's draw a line from here to here. And we can see that this line has a negative slope. So if we were buying the stock all the way up here at this peak, then even though the stock reached our target price right here, we still had a negative return. Now, if we were buying the exact same stock right here and we graph this line to the exact same point, we can see that our returns would be much, much higher if we simply bought that stock at a lower price. And if we bought the stock right here about in the middle and graphed that to the same point, it's still a positive rate of return on this line, but it's not as much of a rate of return as the bottom line when we bought that stock cheaper. And this is what the intelligent investor is trying to say. It's saying that the higher the price that we pay for our stocks, the less future returns we can actually expect. And sometimes stock prices can get so high that the future returns have nowhere to go but down, because the stock is just getting way ahead of itself and the market is being over optimistic and pricing that company way, way too high. So now let's move on to the fourth point, and this says, no matter how careful you are, the one risk no investor can ever eliminate is the risk of being wrong. Only by insisting on what Graham called the margin of safety, never overpaying, no matter how exciting an investment seems to be, can you minimize your odds of error. Now, this is actually a very key point that the book is going to touch on more later on, is this thing called the margin of safety. Now, what the margin of safety is simply just not overpaying for a stock because we are excited about it. This comes back to being able to control our emotions. There is going to be times in the stock market where there is a super exciting company, it is running like crazy, its stock is going up every single day, it seems like everyone is jumping in, everyone is making a ton of money, but when you take a look at the actual value of it, you may realize, hey, this stock is quite overvalued. Those are the points where we really have to control our emotions and just be like, you know what, maybe we'll just sit this one out because yes, the stock is going up day after day after day right now, but people are just kind of speculating on the stock continuing to go up. People aren't really focused on the underlying fundamentals or the underlying value of that business anymore. Later on in The Intelligent Investor, it has a full chapter dedicated to the margin of safety. And basically what it's saying is when you determine what you think the fair value of a stock is, you should actually buy it lower than what you think the fair value is, because we're only human, we're going to make mistakes, we're not the best at predicting things. So giving ourselves a margin of safety accounts for some human error in our analysis. So buying below what we believe the fair value is one way that the intelligent investor says we can minimize our odds of failing and our odds of error. But yeah, let's move on to the fifth point here where it says, the secret to your financial success is inside yourself. If you become a critical thinker who takes no Wall Street fact on faith, and you invest with patient confidence, you can take steady advantage of even the worst bear markets. By developing your discipline and courage, you can refuse to let other people's mood swings govern your financial destiny. In the end, how your investments behave is much less important than how you behave. This is such an important point as well. And it goes back to that thing where one of the largest risks to investors is actually ourselves. And we kind of have to think about this because we could own the absolute best stocks in the market, but we could still lose money on them if we don't focus on the underlying value of the business and if we're just trying to speculate on what the price is going to do. I mean, think about if we bought Google, for example, and then Google drops like 20% over the next few months, and then we just get emotional and we sell out because we're focusing on the price and not focusing on what the underlying business is doing. Google, in my opinion, is one of the best companies in the world, but you can still lose money on the stock if you're being emotional and you're thinking short term. And that's again why it says, in the end, how your investments behave is much less important than how you behave. If we are emotional and if we do not use logic with our investments and we just speculate and get so caught up in what the price is doing from day to day, then again, it doesn't matter what we own. We can own the best stocks in the market and we can still end up losing money because we're making decisions based off emotion and based off price and not based on the actual underlying business. So that is what I believe this point right here is saying. All right, and now let's head to page 6 where this says, it has long been the prevalent view that the art of successful investment lies first in the choice of those industries that are most likely to grow in the future, and then in identifying the most promising companies in these industries. But this is not as easy as it always looks in retrospect. This is actually a very key point because I think that a lot of investors, when they're starting out, may think, well, let's just pick the most exciting stock in an industry that is obviously going to be growing for a long time coming. The intelligent investor is saying investing is not that easy. And we're actually going to skip ahead to, page 16 to better explain and understand why. So here on page 16 it says, Obvious prospects for physical growth in a business do not translate into obvious profits for investors. While it seems easy to foresee which industry will grow the fastest, that foresight has no real value if most other investors are already expecting the same thing. By the time everyone decides that a given industry is obviously the best one to invest in, the prices of its stocks have been bid up so high that its future returns have nowhere to go but down. This passage right here is one of my all-time favorite passages in the entire book, and it's just because it's so true. What happens in the market is investors think that one industry is obviously going to be a massive industry in the future. But what this passage is saying is that when every single investor in the market decides that, hey, this future is going to be the next big thing, then typically what happens is that industry and the stocks in that industry just run up so incredibly quickly. They run up to the point where they get incredibly overvalued. Investors are getting so optimistic on these stocks that the only way that these stocks have to go is down in the future. This has happened before in the past. This can happen when bubbles form in the market. It's just really driving home the point that just because an industry is going to grow in the future does not mean that the stocks are going to continue producing returns while all of that growth happens. And I actually have a really good example of this right here. So what we're going to take a look at right here is Microsoft's stock price. And right here we can see that on January 3rd of the year 2000, Microsoft was selling for a share price of $58.28. This was during the tech bubble or the internet bubble, when investors, thought that the internet was going to be this massively huge industry, which it actually turned out to be. And they were just bidding up these stocks so high because, everyone knew that the internet was going to be the next big thing. So they bid up the stocks incredibly high. The stocks ran incredibly quickly. It formed this bubble. And yeah, take a look at what happened next. We can see that Microsoft stock absolutely tanked. And by the end of the year 2000, it lost more than half of its value and it was selling for $23 a share. Now also take a look at this, because by 2013, the stock was trading for $37.61. So 13 years later, the stock still didn't even fully recover from where it was selling back in all of that optimism, back in all of that euphoria, and back when investors were pricing Microsoft incredibly high. 13 years later, the stock was still underwater. So let's continue going. Right here, we can see that by 2015, the stock is back up to $55.48. So basically, it took 15 years for the stock to get back to where it was during the tech bubble in the year 2000. But also, what is incredibly interesting about this whole story is let's go and take a look at Microsoft's revenue from the year 2000 to 2015. And when we take a look at this chart right here, we can see that Microsoft's revenue was basically growing for that whole 15-year period. So the company, the underlying business of Microsoft, was actually growing for that full 15 years. But when we take a look at the stock price, for that 15 years, the stock still didn't make all-time highs. It was still underwater that entire time. This is what can happen, again, in the stock market. The price of a business can get bid up so incredibly high that the price comes down even though the underlying business is in fact still growing. So now we're going to backtrack in the book a little bit and head back to page 8. And this says, "The habit of relating what is paid to what is being offered is an invaluable trait in investment. The really dreadful losses of the past few years, and on many similar occasions before, were realized in those common stock issues where the buyer forgot to ask how much." So the intelligent investor right here is trying to say that when investors stay rational and we think critically for ourselves and we remember to ask how much are we actually paying for this underlying business, then we can seriously avoid some of the largest losses that people see. The habit of relating what is paid to what is being offered is an invaluable trait. What that means right there is the habit of taking a look at the price of the business that we are buying versus its underlying fundamentals is an invaluable trait. Not just buying a stock at whatever price, the stock is at that day, but actually paying attention to the value of that underlying business and making sure that we're getting a fair value for the price that we are paying, again, is an invaluable trait in investment. So now let's head to page 13. And this says, "Are you an intelligent investor?" Now let's answer a vitally important question. What exactly does Graham mean by an intelligent investor? Back in the first edition of this book, Graham defines the term and he makes it clear that this kind of intelligence has nothing to do with IQ or SAT scores. It simply means being patient, disciplined, and eager to learn. You must also be able to harness your emotions and think for yourself. This kind of intelligence, explains Graham, is a trait more of the character than of the brain. So this passage right here is basically echoing what Warren Buffett said earlier on in the book, and that's that being an intelligent investor actually doesn't have anything to do with, the typical term intelligence. It doesn't have anything to do with IQ or SAT scores. It simply means being patient, disciplined, and eager to learn, also being able to control your emotions and think for yourself. It's really more of being emotionally intelligent than actually being like book smart or having a high IQ. As we read through the book, we're going to notice more that being an intelligent investor is really just about controlling ourselves, learning about our habits, and really just mastering ourselves and our emotions. That is the biggest thing when investing, to be honest. So let's move on, and this is actually on page 13 as well. It's just on the bottom of the page, and it says, and back in the spring of 1720, Sir Isaac Newton owned shares in the South Sea Company, the hottest stock in England. Sensing that the market was getting out of hand, the great physicist muttered that he could calculate the motions of the heavenly bodies, but not the madness of people. Newton dumped his South Sea shares, pocketing a 100% profit totaling 7,000 euros. But just months later, swept up in the wild enthusiasm of the market, Newton jumped back in at a much higher price and lost 20,000 euros, or more than $3 million in today's money. For the rest of his life, he forbade anyone to speak the words South Sea in his presence. So this passage right here is really just showing that one of the smartest people to ever live. I mean, we're talking about Isaac Newton, the guy who invented first principle physics, right? Or not invented, but founded or discovered, whatever you want to call it. This guy got caught up in the emotions of the stock market, and he clearly wasn't an intelligent investor. Even though he was one of the smartest people to ever live, he was not necessarily an intelligent investor because he let his emotions get the best of him, and he didn't think rationally. He wasn't thinking logically when it came to the stock market, and he ended up losing about $3 million in today's money. That is just a clear example that intelligence does not mean you are an intelligent investor. You also have to be emotionally intelligent, think for yourself, and stay rational. Now, the last page in the introduction that I want to talk about is page 17, and this is another one of my favorite pages in the entire book, and I reference this a lot on my channel. So this says, the same people who were eager to buy stocks in the late 1990s when they were going up in price and therefore becoming expensive, sold stocks as they went down in price and, by definition, became cheaper. As Graham shows so brilliantly in chapter 8, this is exactly backwards. The intelligent investor realizes that stocks become more risky, not less, as their prices rise, and less risky, not more, as their prices fall. The intelligent investor dreads a bull market since it makes stocks more costly to buy. And conversely, so long as you keep enough cash on hand to meet your spending needs, you should welcome a bear market since it puts stocks back on sale. So take heart. The death of the bull market is not the bad news everyone believes it to be. Thanks to the decline in stock prices, now is a considerably safer and saner time to be building wealth. So this passage right here, again, as I said, is one of my absolute favorites because the intelligent investor realizes that stocks become more risky as they rise and less risky as they fall. They also become much cheaper and safer to buy as they fall because you're getting a much better price and you're getting much better value for your money. This is also the first instance in the book where it's really trying to drill into investors that stocks going down is not necessarily a bad thing. It's actually a good thing if you're someone who is a net buyer of stocks. I mean, I try to express this on my channel all the time, but I'm young and I plan on buying stocks and holding stocks for the rest of my life. So when I am buying stocks and I'm a net buyer of stocks in the stock market, I should actually want my stocks as cheap as humanly possible because the cheaper my stocks get, the more I can expect my future returns to be. As we just learned a few pages earlier on in the book, the higher stock prices go, the less future returns we can expect, and the lower stock prices go, the more future returns we can actually expect. Intelligent investors realize this. They realize that prices going up is not necessarily a good thing, and prices coming down can actually be a great thing for building long-term wealth. It's also kind of funny because intelligent investors kind of want the market to come down. We don't really love when stocks are going up and up and up and up and up and up because it makes us uncomfortable. It makes us not really want to be buying. It makes us kind of question, should we be selling our stocks now? This is kind of getting irrational. We really like to see stocks getting cheap. It kind of is exciting to see stocks getting cheap because you know that your returns are going to get better and you really aren't speculating. You know you're getting a great value for what you're buying, and yeah, you're just not really speculating anymore. It's a much safer and saner and more comfortable time to be buying stocks when they're not incredibly overpriced. Page 17 is the last page before chapter 1 starts, so that was the introduction to the book, and yeah. Alright everyone, and that is pretty much going to wrap up the video. And if you enjoyed this video or you found it helpful, then please let me know down in the comment section. If you guys want me to continue with this series, just let me know. I would love to hear all of your feedback and how you think I could potentially make this series even better for all of you. Also, if you enjoyed this video and you found it helpful, then please remember to leave a like on it. That really helps out my channel. It will probably really help this video get more views as well, because videos like this tend to not perform very well just on YouTube in general, which is kind of unfortunate. So leaving a like on it will help it perform better and let more people see this type of educational content. So thank you all again so much for watching. I truly do appreciate it, and I'm really looking forward to this series. So yeah, I hope you guys are as excited as I am. Thank you all again, and I really hope to see you guys again in my next video.